thing is done. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed and tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. NASDAQ.com, PSW, North affiliates, or any of their licensed respective offices, personal representative agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. TSW provides education and training services and meant to teach the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses that you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantastic. All right, we are through that, and we are checking out. We've got some people here. That's very good. Everyone says fine, so let's get going. What's happening in the market? First of all, yet another losing day, and I'm freaking on the natural gas contracts. We keep working our bases down. Every time it comes down to this line, down around 178, we buy a few, and then we sell them when they come back around 180. 182 is now the line we're selling at. And you pick up 4 cents here on a few contracts and 4 cents here on a few contracts, and before you know it, you lower the basis on all 10 by 4 more cents. So this is showing 180, but I think really we're more like 185 right now, I'd say, on the average. So we're working down to 185. It's still, it's sort of like a battle of attrition, though. They keep going lower and lower, and we keep lowering our basis. But, I'm comfy bubbling around with 10 contracts, but I don't want to have too many more. Briefly, we have more when it goes down, and we add some more, but on the whole, I'm good with where we are now. In fact, I would like to get back to 5 or 6 if we ever get back to like 187, 186. I feel more comfortable there because then I'd be thrilled to double down at a lower price. Right now, I'm just sort of playing comfortably. Very, very big deal today. We bought back our short SQQQs. Let's see if we can show you that. There we go. Perfect, 5% portfolio. We had 40 of these SQQQ June 27 calls. All right, and they were 180 yesterday. So anything below 180 is great. They're 158 now. They're showing. We called it a while ago 140 to buy these things back. Obviously, haven't logged it in yet. Before I log anything in, I always look to see if it was realistic. If the selling is realistic, I think 150 is really where it's sold at in the end, not 140. We don't think anybody got 140. And it's not. It wasn't an emergency to do it, but it certainly needs to be done because we wanted to get more bearish. So this is how we make adjustments, and I always look. I would think of portfolio balancing. It's like riding a surfboard. I know not everybody has ridden surfboards, but I'm sure everybody understands the concept. You have to find your center of gravity. And what the center of gravity is if we're trying to balance a portfolio, it means that the portfolio stays pretty much neutral and the market goes up or down. Just like when you're standing on the board, you're kind of going along on the board. Now, if you want to go left, you shift left. If you shift your weight left, if you want to go right, you shift your weight right, but just a little bit. You make very, very small adjustments. You don't make big, giant adjustments. So what we do with the portfolio is once we get it balanced the way we want it, and this portfolio is very, very bullish, then if you want to flip bearish, you find a piece that you can adjust without upsetting the balance of the rest. In this case, this particular piece only had $6,300 worth of profit left to give us out of like 25,000 total. Well, here you go, 20. It started with 25,400. We collected 19,000 of the potential profit. We're down to like $6,000 left. We're done with it. It's fine because we have to wait till June to get the next 25,000. It only took us a month. See this 2.8? It took us 1 month to make 19,000. So why would we want to wait 3 more months, 4 more months until June to collect 6,300 more? We can find another way to make 6,300 between now and June. And this obligation of 40 short SQQ calls had a very, very large piece of, it was taking up the main margin use of our portfolio in this particular play. So we free up a ton of margin. We spend cash. We have to spend $6,300 to buy these back, but that's not a big deal because we got $126,000 in cash. We have more cash than our portfolio's worth. All right, so that's not an issue. So we've released a lot of margin. We gave up a little bit of cash, but what have we done though? Because all we've done is remove this position, which is actually a bullish position. We've flipped the whole portfolio more bearish, right? We've taken out $6,300 worth of the balance to the bullish side. All right, so what are we left with then? We're left with, I mean everything, I mean on the hedges. We're left with these SQQs, which we're here to protect, by the way. They were here to protect this one. We spent $3,000 net here to protect this position. So you look at this and say, oh boy, it's like a $3,000 loss. It's not a loss. It's a loss against this $19,000 gain. Like we would not have had the guts to stay in for this $19,000 gain if we didn't have this hedge. So fine, we're only up $16,000 on the two. We're waiting on this one because if the NASDAQ does fall off, though, we think it's going to drop in the next couple of days. If it does fall back, we might get a buck out of this thing. If we get a buck back out of this, I'll be thrilled because that's going to be our $3,000 back. Then we'll have these naked, but I don't mind that. March isn't very long. 2 weeks. I don't think that they're going to get back to 28 in 2 weeks. This here, we're giving them 3-4 months to get to 27. That one made me a lot more nervous. These we can always roll. And so what we're going to do is basically we're going to cash out these. That'll make us if we do cash out the March 23s, that will again flip us back. Understand, because we will then have the naked short March 28th. That'll flip us back to bullish again. So right now we're bearish because we have these TVAs. Oh, we're not bearish. We're leaning a little more bearish. I wouldn't say we're bearish. We're actually just basically back to neutral. We were extremely bullish, but now these are all bullish positions, and then we've got these two hedges. That's where we stand now. This is a fantastic turnaround, though. I mean, we were down 20% like a month ago in this portfolio. Now we're up 11.5. So I'm thrilled that we're here. And although obviously the overall gain isn't where we want it to be yet, still it's something you want to lock in. When you gain 30% in a month, even if you gain 30% from being down 20%, you still want to lock in the 30%. You have to realize that it's not normal to make 30% in a month. So you say, gosh, I made 30% in a month. I should be cautious now. And people could learn to do this at a casino, they would get much richer. Because there's another thing people don't understand about casinos. There are streaks. If you have a lucky streak, stop playing. Nobody does that, of course. But if you have a lucky streak at a casino and you walk away, you will end up with much more money. What the casino counts on, this is why they give you comps and give you a free room and fly you back if you win too much. It's because they want you to keep playing. They know if you keep playing, ultimately, you'll lose. Okay? So when you're way ahead, quit. When you're way behind, actually, that's the funny thing, though. People do the opposite. People, when you're behind on a position in your portfolio, whatever, that's when people tend to quit. After they've had a losing streak, people quit instead of when they've had a winning streak. It's terrible. It's the saddest thing. I mean, it's very hard to understand number theory, for most people. It's just, you don't do that. If there's a streak against you, I mean, again, it's a random streak. If you're the worst stock picker in the world and you don't know how to play the market, yeah, you're going to have more losses than wins, and your losing streaks will be consistent. But if you know how to play properly, you understand that a losing streak is just a statistical aberration against you, and that you can ride it out. So, which is what we did. We were down 30-something% at one point in this portfolio, and we went more bullish because we had the cash on the side. We were prepared to ride that out. All right, it would have been a terrible time to quit and say, okay, we lost all this money, let's get out of here. That's the exact wrong thing to do. The point was to say, how are these positions? So some positions we cut, some positions we pressed, and this is where we ended up. We made it, and again, like I said, a 30% gain in a month is a really good recovery. All right, so now we're back in a profitable stance. We still have a lot of good positions that we're very happy with, and we'll have to evaluate them closely. But now, I certainly don't want to be this bullish on one position. It's a it's a big position, huge risk. So we're taking it off the table. All right, let's see if there's any questions on that. Oh, hardly any questions at all. I don't think many people out of it, only 31 have been traded. Well, I can't control that. I mean, it's certainly there to be traded. The last trade was, in fact, just while I was talking, somebody got out at $1.50. So I don't know I don't see the count here. I can't tell, but what time is this? 1 p.m. Right at 1 p.m. Somebody sold more at $1.50. Or bought more at $1.50. Because we're buying to get out. I don't know how many people actually have. So, but the bottom line is, I mean, that's what we're going to officially. That's effectively the position. There is no hurry, though. You shouldn't be pushing to get out. Just ask for your price, because we're not really that bearish. We think that, we were not bearish when we were at the bottom. We're certainly not going to be suddenly bearish on it now. But because we're so far ahead, on the off chance that this is a bear rally, answering Calvin's question ahead of time, on the off chance that this is a bear rally and just a bounce, then we don't want to get caught with our pants down and get screwed. All right? But I certainly wouldn't go overpaying for the thing. I wouldn't pay more than $160 to get out of this position. All right? Because that $160, don't forget, yesterday, in fact, here you can see it. Let's go to SQQQ. SQQQ. And it's what, the June 27th? So right now the bid is 140, the ask is 160. Copy that, go to charts, go to grid. There we go. Okay, so today, they're all going around one. Well, that's a tight spread. Let's see. 149. Then there's somebody went for 155, somebody went for 157, and somebody went for 150 just now. All right, so in that range. So they're even though they're asking 160, nobody's paying it. So maybe not that many people actually fit the position, or maybe people took smaller portions. I don't know, but I do know that it's certainly a play. It works as a trade. Let's see. All right, so that's that. What else is going on in that portfolio? Oh, well, in the short-term portfolio, speaking of streaks, our ridiculous profit streak continues. In the short-term portfolio, we also had these. Oh, no, we didn't. We had different ones. We had the March 24 calls. We took those out also because they were 35 cents a while ago. We got rid of these things also. Same logic, though. It's just we made so much money, there was no point in leaving it on with the last few. And if we're gonna hedge, we're gonna get a better hedge than that, because it's $4 out of the money and it expires in a couple of weeks, so we can do better. Here we also have TZA as a hedge. We are generally, though, and SDS as a hedge. So we have quite a few hedges here. But don't forget the short-term portfolio, which is up a ridiculous $300-something thousand, is protecting the long-term portfolio, But the long-term, oh my God, and the long-term portfolio just keeps going up and up and up like crazy. The long-term portfolio is now at 790, started with 5. Wow. And we keep saying every day I look at this, it's been going on since 45% though. I've been saying since 45%, I think we should cash this out because this is just crazy. I mean, it's getting to be a ridiculous amount of money that we've made on this portfolio. It's meant to be conservative. It's only 2 years old. It's up 60%. It is conservative, and all these positions are good positions. There's nothing here we looked last week, and we did a review last week. There's nothing here I want to dump. I like all these positions, but I don't know. When you get this close to, and by the way, this 58% reflects the crappy bid-ask spreads that you get in the market. Also, like all these bid-ask spreads, if you actually go to these positions, you'll do better, not worse. So we're up around 60%, and it's a shame not to lock that in. But on the other hand, we still have tremendous amounts of cash on the sidelines that we're not using. It's a tough call. It really is. I don't like being. I'm more comfortable being on track than being way ahead. I don't like being way ahead. It just makes me want to take profit and go take a vacation because that's what you should do when you're way ahead. And if this wasn't my job, that is what I would do. Anyhow, all right. So that's the long-term portfolio, and then we've got the butterfly portfolio. That one's easy because that always makes money. Whoa, geez. Still though, 116%. It's like crazy. It's because the VIX is coming down, and it's good for because of the way we sell a lot more premium than we buy. So when the VIX starts calming down, all of our positions start improving. But this is crazy. 116%. This is our super conservative portfolio. It's up 116%. We did flip these positions bullish though, and these are ones we're going to not necessarily cash, but if you pick them apart, and we just did last week, if you pick these apart, they're not really butterfly plays. Like here's a bull play on Disney. This is bullish. This is not a butterfly play. Here's a bullish play on Apple. Here's a bullish play on gold. So that's not what the butterfly portfolio is usually about. OIH, bullish play. Valero, bullish play. We picked, when the market was down, Walmart, bullish play. When the market was down, we weren't doing badly in the portfolio, but we called a bottom, and in the butterfly portfolio, we took the opportunity to say, hey, you know what? Let's not sell puts this month. Let's not sell calls this month. That left us net very bullish because we have, and also we cashed in some of our long puts that we're protecting because we said we don't need protection at this point. Do we have any, I'm going to see if we have any real butterfly plays left. Yeah, long put, okay. So Texas Instrument, right? We have these 10. We own 10, 43 puts. So when the put, like we bought it for 220. When Texas Instrument, if it goes way down and this put goes for like 350 and we think that's too low, that's what we do with these positions. Like we cash in the put, the long put. That then leaves us, if we cash in this long put, that then leaves us with a short put and a bull call spread. Or just a bull call from on the longs, depending on how we set it up. So that is what we kind of did. We locked in the position. We bought back the short calls. We sold our long puts, and that just left us so bullish in this portfolio. But luckily, it was the exact right time to do it, and we called the dead bottom in the market. But again, timing, luck. Okay, the worst thing you can do is start thinking you're a genius when you do these things. It's like, no, we had good timing, we lucked out, we came in right at the right time. You're not likely to do that over and over again. So when you're this far ahead, you got to say, okay, good time to pull back, take a close look at what we have, protect, and even if you're not going to cash out, at least protect, get to neutral, calm down, and then see where things go. Okay, I don't need to make another 10% this month. I need to analyze the market and see where things stand so that we can set ourselves up for making our next 20, 30% in the future. Okay, but you know, when you make it, you know, we had a huge month last month. We don't want to be greedy and try to double down when we could get the whole thing reversed on us. All right, any questions on that? Would you recommend the cover on a long ABX now? Well, where is ABX now? I'm probably going to say, after all that, I'm probably going to say no. Yeah, okay. All right, no, actually, I will say yes. 15 will be hard to cross for ABX, okay? It's had a really good rally. I mean, I certainly think it's good for, and we don't have a big enough chart to show it. There's no reason ABX shouldn't be at like 20 or 30, except you have to wait for the price of gold to come up. So when you ask me, you say what's ABX going to do? I don't care about ABX. I'm looking at gold, GOLD. So how's gold doing? Gold's up at 1250. That's a little bit. Now it looks to me like gold's probably consolidating here for a break higher. But it needs to work off a little bit of steam. But I think this is, see how it's stuck up here? That's a longer term chart. It hasn't really been that much higher than 1250 for a while, and 1350 was the next high. So there's not a huge amount of gas left in gold's tank at this particular moment, unless something bad happens to Mr. Dollar. So is something bad going to happen to the dollar? No. Okay, again, so it's everything you have to think about, all the related factors and how they're going to come together. So what's going on? You've got Draghi, ECB's having a meeting this week, okay? They're not going to say we're tightening. Everybody's expecting stimulus, actually, from the ECB. That's why the dollar's coming back this week. See how the dollar's popping back up? So everybody's expecting more easing from the ECB. If there's more easing from the ECB, the dollar goes up because the euro goes down. Also, you've got Britain over the next 6 months, I think by July or June or whenever they have that vote, they're voting to leave the euro. That could lead very quickly to an entire collapse of the euro. These are not good things for gold. Okay, so right now you have the immediate pressure of the ECB meeting. You have the longer-term pressure of Britain leaving the euro. Then you look over to Japan and you say, well, Japan certainly isn't going to be tightening anytime soon. Their easing isn't even working. So that's another one that strengthens the dollar. So there's two factors. And now you look at China, and China's into easing also. So we've now exhausted all the major currencies of the world, and everybody's easing. Nobody's tightening. The only people who aren't easing, we're not tightening, but we're not easing, is us. So we don't have any expectation of the dollar going lower. But now, other factors, though. If the euro is collapsing, if banks are giving you negative interest rates, then maybe more people will start buying gold. So now we have to start thinking maybe there's going to be some actual demand for gold. And what do we know about the COMEX? Remember we were talking about the COMEX months ago. The reason we went super duper long on gold 2-3 months ago was because I was pointing out that at the COMEX, which is where they store the physical gold, that there's, I think it was 250 times more demand contracts than there was physical gold for delivery. So if the people who have all these open demand contracts actually said, hey, I want the gold delivered, there's no possible way to cover it. All right, so it's a tricky situation here. There's not an easy answer because the problem is you have to consider with ABX, you could get very badly burned to the upside. All right, but here's the easiest part of the answer, though. I don't think ABX is going down. All your extensions are here. Yeah, thanks. So I don't think ABX is going down. I don't know about covering it, though. It depends on what the position is. I would say, okay, here we have two rules at Bill Stock World, right? Always sell into the initial excitement, which is where ABX is kind of now. Okay, what do we mean? What do we mean by the initial excitement? Oh, what are you doing? Oh, that's the wrong thing. No wonder it didn't work. Always sell into the initial excitement. Now, what's the initial excitement? Here's your rally. AVX rallies up. What does initial excitement mean? When it starts running out of steam, now is the best time to sell because you're going to get the best prices for selling forward calls, okay? So it's an issue of don't be greedy more than anything else. So then you want to look at the prices. Now, rule number 2, we only have 2 rules. So rule number 1, always sell the initial excitement. I hate to sell ABX so cheap though. Rule number 2, when in doubt, sell half. That rule certainly applies here. So I think a half cover to take some advantage of the move is probably appropriate here. I don't know what your position is, but if we take a look, we'll take a look at ABX. So remember, between now and June, you've got the weakness of the euro because of England possibly voting out. But if Britain does leave, and nobody's really playing this now, but if Britain does leave, you will see panic all over the place. The euro, the whole euro is going to, I think, probably completely collapse if England leaves. It's just going to be like the straw that breaks the camel's back, and then country after country will start going, well, this is bullshit, and they'll start doing their own thing. So July's off the table because July is when we think that gold might skyrocket. But if you look at April, let's say, and you can sell, well, see, here's the problem for me. You can sell the $15 puts for 50 cents. It's like, compared to the possibility that ABX goes to 20. So it's not even an exciting sell. We haven't covered ours. I don't know that we would. I think what I would do though is depending on your position, I would probably want to move to like a bull call spread and make sure I have a 2-to-1 bull call spread that if I knew what you had, it'd be easier. But let's say you have the stock at 1350, right? So if I have the stock at 1350, I'd sell the stock. I would have sold at 14, frankly. But I'd sell the stock at 1358. Then I would take my 1358, and instead of having, let's say instead of having 1,000 shares at 1358, I'd rather have 10 contracts of the 10s, and you see how they're about 570, let's say. So it is 570 right there. All right, so the 10s are 570. And the 20s are 240. So what's that? 570 minus 240 is 340. So for 340, instead of 13, I can have this $10 upside that's $3 in the money. Why would I not do that? Then I'm good to 20. And now, here's the difference though. See now, instead of having to cover a $13 call, a $13 stock, using just $350 of your money and taking $10 off the table, and you're giving up no upside at all, okay? You still have the same upside all the way to $20. And now, the coverage that you choose, even if you take the 50-cent coverage, it's proportional. So here you can cover with these at 50 cents, and I'm talking about half coverage still though. So you take the long 2018 10-20 spread, to 350, you cover with these guys, which would be effectively 30 cents of coverage. But now you're covering 10% of your long position versus covering nothing of your long position if you cover 30 cents out of 13. That's step number 1. Step number 2, though, is because now you have $10 on the side, you don't give a damn if Barrick drops back to 10. Because if Barrick drops back to 10, you're going to roll your $10 calls to the $5 calls. Right now that roll is 570 to 866, so it's a $3 roll. If that roll goes to like like 250 or $2, you're going to love making that roll because then you're going to have a 520 spread. And you'll be in the money because it'll be down at $10 and you'll have the 5s. And you'll expect net 5 on the $5 calls with $10 more of upside. So you see, it's a matter of changing your, adjusting your position, taking your cash off the table and moving to a play that has a nice upside, but if it goes the other way, which is why you're taking your cash in the first place, if it goes the other way, big deal. You take some of the cash you took on the sidelines and put it back to work. And you've improved your position over where you are now. Oh, and by the way, improve, what I mean is because you're spending $340 on the spread, on the $10 spread, right? You said $340, I think. So the 10-20 spread, $340. If you spend even $250 to roll to the fives, right? That would be $6 total that you spend, not counting if you sold some puts, some calls, I mean. Then you'd be in the thing for like $6 at 5. What's that? That's net 11. See, so you reduce your cost from $13.50 to 11, even if it goes against you. There's no reason not to do that. It would make no sense not to do that, right? Clearly, owning the options is going to be better and more flexible than owning the stock. Oh, and also, of course, if it does blast up to $15 and goes over 15, then you can just widen the spread. You can either push the 20s to the 25s. How much would that cost? $279 to $150. It would cost you $1.20 or $1.30 to buy $5 more of headroom if you chose to go that way. Or you can do a lot of other things. I mean, or you can just add another spread or something like that. There's so much flexibility because instead of having $13.50 tied up in ADX with 30 cents worth of protection, you now have $13.50 you have $10 in cash and a long ADX bull call spread. But you have the same upside all the way to $20. Okay, so people wonder why we hardly have any stocks. This is why you hardly have any stocks. It doesn't make sense to have stocks. Okay, stocks are just a thing that people who don't know how to trade options have. That's what they are. Oh, okay, so you have it there. Oh, I guessed it. Isn't that fantastic of me? Wow, I nailed that one. I'm pleased with myself. All right. Meanwhile, the Fed, damn it. None of you guys reminded me. The beige book is in a half hour. You got to pay attention. All right. Meanwhile, we can wait some more time. The beige book is in a half hour. I forgot all about that. So back to looking at the futures very carefully. Everything's going very nicely, actually. Look at the Russell 1060. That is fantastic. The NASDAQ's coming back up, so everybody should be able to fill and exit their positions on the NQs. On the NQs, on the whatever they are, the SQQQs. We've got everybody's looking good. God bless it. We might be strong. I'm very worried about this beige book, but if the beige book comes out okay, then the whole thing might start taking off again. Gasoline's been selling down. Oil is back at 34.36. Been real rocky road on oil. Natural gas. That's the front month natural gas is 169. It's terrible, but better than it was. In fact, 165. Didn't I say it was in the bottom at 165? And that's where it is. Other than that, look at WYNN is doing nicely. Silver's back at 15. We like silver long over that 15 line, but it's very dangerous. Certainly not right now, though, because the dollar is still very strong. 98.27. It's weakening a bit, but not that much. Boeing doing nicely. The Nikkei's holding up okay. Tesla coming back, even though somebody gave it a horrifying downgrade. Amazon cut 600. God, what a waste. The VIX is down to 1750, and Apple is barely holding that 100 line. Wow, look at that, 103 cents. And that's key. I mean, if Apple doesn't hold it, down goes the NASDAQ. It's all about the beige book. I can't see how the beige book is really going to be good, though. That's where I run into trouble. We had a lot of bad PMI reports, and the beige book is essentially what the beige book is each Fed governor is tasked with going out in their region and speaking to local business people. So they find, and they try to find like bigger businesses. But some of them do it themselves, some of the staff do it, whatever. But they're generally going out and talking to people they're friends with. Much of it's an informal survey. And they gather information, and they get anecdotal reports where guys will say, hey, what do you think about the business? What's your outlook? How do things look? Blah, blah, blah. Are things expanding, contracting? And they got their little checklist of questions they like to ask people. But my objection to it is that essentially it's rich guys talking to rich guys, like, it's Fed guys speaking to business owners about what they think of the economy. And that's not necessarily a real view. Also, the biggest problem we have now in the entire economy with all economic forecasting is screwed up right now because, and the Beige Book's a great example of this, there are years and years and years of relationships with people from old school businesses, okay? Not many of the Fed governors hang out with Mark Zuckerberg or any of the guys, or the Uber guy, whoever I can't remember what his name is. But, they're not hanging out with the guy who founded Uber or Mark Zuckerberg or people in the new part of the economy. Their friends, the Dallas Fed president's friends are oil guys. And they're going to tell him it's awful down here. It's like chaos. Everything's falling apart, blah, blah, blah. All right? But they're not the ones in the growing industry. There's a giant change coming in the economy, in the global economy, where we're moving away from fossil fuels and moving into alternative energy. And it's causing chaos because it's not just that we're not buying oil. That's obvious, right? But the banks who lend money to the oil companies, again, their best customers are oil companies who are constantly drilling and exploring and borrowing money and running lines of credit and so on and so forth. Not to mention all the money, the petrodollars that flow through the banks as oil gets shipped and moved overseas and blah, blah, blah. We've cut our imports in half. Again, people should be giving Obama a parade down the street. We've cut our oil imports in half. It's something we dreamed about one day happening, and it's already done. But imagine how many less dollars are going overseas because we cut our imports in half. Billions, hundreds of billions of dollars every year aren't leaving this country. Fantastic for this country. Okay, because what happens? You go buy a tank of gas, you give the guy $50. What are you getting in exchange? You're getting something you're literally going to light on fire. You will have zero left when you finish burning it. And you exchange 50 perfectly good dollars that then go overseas into some Saudi guy's pocket. That doesn't help America at all. But it helps America tremendously when we don't spend that money. The less we spend stays in this country, circulates through this country, and creates jobs and so on and so forth in this country. And yes, there are oil jobs, and some of the money does go to America, but you know what? Those jobs are generally still there. Okay, it's the imports that got cut in half, not the American drilling is up miles. So don't be confused by the rhetoric people have on that stuff. Okay, U.S. drilling is up. Obviously, for the most part, our local drilling has covered the downfall of the imports that we've had. We make more ourselves, we import less. It's very simple. But therefore, the money flows around and stays in America. Still, though, all the banks that have the old-style business, and we're dealing with the petrodollars and so on and so forth, their business sucks. So you talk to the banks, business is really crappy, the oil guys aren't borrowing, blah, blah, blah. Now, when the oil guys aren't spending CapEx, when they're not exploring and producing more oil, that then flows down to all the manufacturers, right? We don't have a lot of manufacturing in this country, but you know what our biggest manufacturing is? Heavy equipment. The stuff we make for the frickin' oil companies is our biggest source of manufacturing money. All those gears and pumps and drills and blah, blah, all that stuff is made in America because it's heavy and it generally is best made in America. You don't ship a lot of giant gears in container ships. It's not worth the trip. So that's what I mean when I say everything's changing. The economy is changing drastically because of the change away from fossil fuels and moving towards solar, wind, local fossil fuels. Deep sea drilling thing is dead. That kills then the towns that used to benefit from it, right? All the coastal towns are not doing as well. Houston does worse. So all the guys you used to talk to about how the economy was are all depressed. You're not meeting the new people. This is the problem with the Fed, right? They're not going out and making new friends. You have to wait 10 years for the next generation of Fed governors to come in, and they've got the young, hipper friends who have the cool new businesses and such. But there's a tremendous lag when you do these economic studies, and that goes for also the statistical reports. We're measuring the old economy. That's why everybody freaks out when the price of oil is low. Why on earth would you freak out when the price of oil is low? Okay? Again, it's not an indication of a slower economy. We're all doing the same amount of stuff. The actual demand for oil is the same. The price of oil is down, not the demand for oil. It's down a bit, but not a lot. It's not an indication of a sagging economy. It's an indication of less demand for oil, which is a very, very, very good thing, but not for a very big segment of the measured economy. So we need to change our measurements at some point. That's going to take a long time. So meanwhile, we're stuck with all these reports like PMI and things like that make it very, very depressing looking. You know, you look at Europe's PMI, China's PMI. We're all based on this basically energy economy. It's such a huge part, and it's getting killed. But it's not a bad thing. It's actually probably the best thing that could happen to the global economy, long term. Short term, there's going to be pain as you move away from one thing to another. All right, so that's what's going on. So that's what we're prepared for in the beige book. We're going to get bad outlooks, but you got to read between the lines because what they think is bad isn't always bad. All right, so let's see. Where is Tesla heading? At the moment, it's going up a bit. But I don't like Tesla at all. I mean, it's an incredibly overpriced car company. Let's see if we can show you. That's not Yahoo. That looks like Yahoo. All right. I mean, look, here, this is, I don't want to go to the whole thing about Tesla. This is the problem with Tesla. They sold $4 billion worth of cars. They lost $800 million. Okay? They have a market cap, I don't know, it's tough to remember three things. They have a market cap of $24 billion. Okay? Here's Ford. Ford has a market cap of $52 billion. So Ford has a market cap of double Tesla. Okay? Let's remember Tesla made $4 billion in sales and no profit. And lost money, but even though it's just no profit. Here's Ford. Ford has $149 billion in sales and $7 billion in profit. Okay? See this number here? Like, oh, it doesn't highlight. Yeah, it does. There you go. See that number there? That's double Tesla's sales. See this number here? That is infinity times Tesla's profits. If you took Tesla's loss of $800 million and you completely reversed it, and if they made $800 billion, so in other words, if they were dropping 20% to the bottom line, they still would be making 1/10 as much as Ford. Okay, so essentially you have to double Tesla's profits. You have to wipe out the loss, and then you have to add another $800 million. That gets them to 10% of Ford. But in reality, because Ford is not an abnormal car maker, and in reality, a car maker drops 5% to the bottom line. All right? So Tesla being a $24 billion company, you say, well, what's it going to take for a $24 billion company to make $1 billion to justify 20 times earnings, okay? So for Tesla to make $1 billion, they have to make $20 billion. They have to make 20 times, because $1 billion would be 5% drop in the bottom line. So for Tesla, as a bigger, mature car company, to make $1 billion, they have to have $20 billion in sales. And we're being kind, because they have to grow those sales first. They have to spend money. They have to expand. They have to build plants. Think of all the things they have to do to get to $20 billion when they're at $4 billion now. Okay, they're not selling movies like Netflix, but they're being valued like Netflix. With Netflix, they get a new customer, they just give them a password. That's their cost of acquiring a customer. When Tesla gets a new customer, they have to build a car. They have to buy parts. They have to add people to the production line. They have to add robots, whatever they're doing. They have to get the financing together. They have to do the leasing. They have to move it from place to place. They have to add more people on the ordering desk. You know, it's not the same thing at all, but they're being priced like they're a .com company. They're not a .com company. They deliver motor vehicles. Motor vehicles are 5% margin of net income. That's normal for motor vehicles. Their valuation is, I mean, ridiculous is not a adequate term to describe the valuation of Tesla. And as I just said, until they're selling $20 billion worth of cars and doing it at a nice profit for motor vehicles, they won't be worth what they're being traded at today. So it took them how many years? What, 6 years they've been in business? It took them 6 years to get to $5 billion, to $4 billion. It took them 6 years to get to $4 billion, and they need to get to $20 billion. So even if you assume they're going to double in 5 years, which would be very impressive, to $8 billion worth of cars, all right, and batteries and whatever you want to throw in there, whatever you want to say, pretend they've got extra going in. And by the way, that's a very false premise, by the way. The Gigafactory, right, they're going to start selling batteries. Who are they going to sell batteries to? Pretty much themselves. Okay, they already buy the batteries. They already sell them. When they sell you a car, the cost of the battery is in the car now. Okay, so if they make a factory that sells the batteries to themselves and then they sell you the car, all they're going to be doing, and this is where Musk is a genius though, they're going to be double booking the revenue of the battery. They're going to first make the battery. They're going to make the battery, they're going to sell it to Tesla for $30,000, Tesla's going to put it in the car and sell you the car for $80,000. So now the same car with the same revenue that Tesla is now booking at $80,000 will now be booked as $110,000 because they're going to book the car revenues and the factory revenue at the same time. That's freaking ingenious. Okay? So that's one way Tesla's going to boost their sales, but it's not going to boost their profit. So it's basically a scam, okay? The guy has taken a classic model of a car company and turned it into essentially a scam. It's a Ponzi scheme. The other ridiculous thing about Tesla is that they guarantee the reason people can afford the leases on Teslas is because Musk guarantees 50% value to the leasing company for the car. So in other words, they guarantee that after 3 years, you take your Tesla back and it's worth $40,000. So you only have to lease $40,000 of it over the course of 3 years, which is whatever the hell that is, like $1,200 a month. So between that and some environmental credits, they get the lease price down to about $1,000, which is, you know, palatable. It's about the same as like a Range Rover or something like that. Or a nice sports car. You know, any nice sports car is going to be about $1,000. But the thing about it is the battery. Anybody who's had a laptop for 3 or 4 years knows those batteries start losing their charge. The batteries they have in the Teslas are the same as a laptop battery. They just have like 50 of them or 60 of them or whatever they have, or 100 of them. But they're the same batteries, basically. So after 3 years, those batteries, you can't say those batteries are worth anything, really. They start losing their charge. The car's worthless. So when you factor in the decay of the battery life, as well as the wear and tear on the car of a normal car, those cars aren't worth $40,000. Because he sold so few cars early on, again, Ponzi scheme, he had so few cars early on that it doesn't hurt him to take a $10,000 per car hit as they come off lease. But the more cars coming off lease every year, the more he gets hit 10,000, 10,000, 10,000 in the real value of the cars he takes back. And those are not on the books. He's not looking. He doesn't book any of his losses. I mean, it's a loss once it hits the paper. But until he realizes the loss, they act like those cars are really worth $40,000 coming back. Okay, so that's like a ticking time bomb in their business model. That's why he wants to go to Mars. He wants to get out before everybody catches on. He's trying to get to Mars so they can get away from this thing before it hits the fan. So certainly not bullish on Tesla, but you can't bet against him because he's such an incredibly good con artist. Let's see. What are your thoughts on IDB or LABU? What the hell is LABU? I don't even know. Am I being silly? LABU. Oh, no wonder I don't know what that is. S&P Biotech, I don't have an opinion on that. On IBB in general, I've never played this one. Let's see, Biotech bullish 3 times. Well, I don't know what the decay factor is. It's probably got a terrible decay, this one, I imagine. I've never played it, and I probably wouldn't. IBB, on the other hand, though, well, freaking expensive, isn't it? It's still way up there. I do like biotech. I mean, long term, I think biotech's a winner. Let's see. We went from 400 to 240, so we lost 50% almost on IBB. LABU went from 20 to 4. You see what happened here? So you went 50% down here, and here you lose 16 into 22 is a lot, right? It's like 80%. Is that about? Yeah. So honestly, though, it actually worked out for you. If you were in LABU, you only lost 80% when you really should have nothing. You know, because biotech dropped enough where you should have lost 120% of your money. That doesn't happen. That's actually the good thing about these ultras is when they do bottom out, they actually aren't as bad as you think they're going to be. So it's actually an interesting way to play because I don't like playing IBB because it's so expensive. But let's see if these guys even have options. I've never played it, so it's all adventure for me. LABU. Oh, they do. Look at that. Oh, I'm all interested now. Short term only, out to September. Let's see. Oh, look at the spreads, though. Nobody plays them. That's the problem. Bid 210, ask 580. Nobody's touching these contracts. That's a shame. June's not so bad. All right, so they're at 7. No, that one is. That one's super wide. All right, let's say we bought the 5s for 320. I would. Oh no, probably 340. Let's say you have to buy the 5s for 340, and the 8s are 170. So for net 170, you can get the 5-8 spread. That's actually quite good. It's not a bad way to play biotech. You're only playing for like for 3 months, a little more than 3 months, but you're going to get if you bought that 5-8 spread, and you pay $1.70 for that, you're going to get you make a $1.30 profit, which is a very nice profit. You're in the money because you're only paying net 170, so you're paying $6.70. And it's at 734. So all IBB has to do is not go down. I wouldn't worry about the decay over that period of time. So all IBB has to do is not go down, which I think is a good bet, and you're going to make a nice return. So I'm actually in favor of that, surprisingly. Then again, you could also, and I don't think that's a bad play either. I think you can also sell these puts. If you can actually get 90 cents, that'd be awesome. I don't know if you can, but you can get 75 cents for the puts. And those are the $5 puts, so that all that would do is leave you long on LABU at net 5 if everything goes to hell. So that's a nice way to reduce the cost also. So that's not a bad play. You know, I mean, I think biotech is going to be a bit depressed into the election, but Sanders is gone. He was a real scare for biotech. And Clinton is although she's a hard ass and she talks about going after Valent and whatever, she's still obviously going to be enforcing. She's going to be expanding Obamacare. All right, so yeah, the guys who make crushing, ridiculous margins on drugs are going to have some problems. But on the other hand, the guys who just want to get in there and sell drugs at competitive prices are going to be thrilled because she wants to have everybody in America insured. And you can be damn sure, by the way, if she's president, those last 30 million uninsured people, which is 10% of the country, But she's going to make damn sure those last 30 million people get insured. I mean, that was, healthcare was her thing when Bill first got elected. That was her little project that Congress slapped down. So as president, she's going to rip their balls off basically until there's health care for everybody. So, I mean, that's pretty much a guarantee. So you're going to have another very nice boom in biotech, because the boom we've had since 2010 has been as we added 15 million. All we did is insure about 15 million more people, 20 million more people. We still have 30 million uninsured people. Okay, so we're going to get the same kind of boom and expansion of healthcare coverage that we had under Obama, under Hillary. So I'm gung-ho for that. It's a great play. Okay. Let's see. Oh, wait. I can't remember. It's 2 o'clock. What time is it? Oh, my God. It's 2 o'clock. Sorry. All right, beige book time. I got to put on the volume on the TV so we can make sure we know what's going on. We got to find the beige book. That's always the pain in the ass. Fed beige book. Damn it. All right. And where are our indexes? They're probably hanging out in the same place. Let's see. Yep. If I was going to guess anything right now, I would short the Russell here with a stop at 1060, so 105,870. And on my assumption that the beige book is going to sound bad. Even if it's not actually bad, it's still going to sound bad. All right, and that's, see, gold's going up. So here's silver off the 15 line. We should have played that one. But that would be my key play. Would be to short the Russell at 105,850 at the moment. Now let's do one. See how it works out. Okay, this is fun. Active trader, Russell. Oh, by the way, see, this NGM6 is because I started watching the next month gas contract, but it's a dime spread. I'm not paying a dime spread, so I have no desire to roll in the dime spread between the two contracts. I mean, it's always nice to get another month, but not for that much money. Okay, so let's sell one. Oh, and look at that. The second I put it in, there it goes. Took my money. Okay, so now we're short of 108.50. My assumption on the beige book is we're back around here. Let's say 54. So that's going to pick up about 450 bucks. So if you want to make 450 bucks, that's the way I think it should go. All right, where were we? Oh, yeah, we're supposed to find the beige book. Seems to be this thing. We're waiting for the March 2nd report, and we've got 1 minute. What are they talking about? Don't tell me they're not going to announce it when the beige book comes out. See, the thing about the TV people is they have an advanced copy, so they already have a copy, and they're going to be able to release notes quicker than I'm going to be able to read it. That's why I like to just check with the TV right at the critical point. So how are we doing? 2 o'clock. Ready? Not ready yet. Oh, but already it's breaking out here. TV's got it. New York and Dallas flat. It's mixed activity, but not good. They're blaming the snow. Auto sales mixed. Declining in Dallas, Kansas City. Modest growth in labor. Consumer prices steady. Energy is still contracting. Strong dollar is bad for exports. Ah, finally. Jeez. Stable credit. Agriculture flats down. Okay, so nothing in there is exciting. It's weak. It puts the Fed back on the table as far as easing. It certainly stops them from raising rates in March. That's technically bullish for the market, but I think on the whole, nobody expected them to raise rates in March, so I think this bet's going to stand, and we should get a bit of a sell-off, but not much. I don't think it's worth a big sell-off. I think it's just exactly what I expected. You never know what's going to surprise people, but it's certainly what I expected out of this report, and I think that people reading it are probably going to be a little bit to take money off the table, but let's take a look. It's kind of long. It goes from here to, whoop, okay, no. Okay, so here, this much is the summary, and then the rest is district by district. Oh, here, you can play along at home. Control-C, and I'm going to go to this, and I'm going to go like that. There you go. That's the beige book link. Now everybody can play the home game. I always talk about it as Fed speak. Okay, you got to be very careful about the language they use. And let's without going over the whole report, let's take a look at that. So we got the 12 districts indicate economic activity expanded in most districts. See, in this way, when I highlight this, when I go through this for the members, I annotate it. Most districts is something put in purple because it's Fed talk. You know, and then you got to say, well, what is most districts? There's 12 districts. So what does most mean? So economic growth moderately. Moderately is not exciting. In Richmond, San Francisco, modest is worse than moderate. In Cleveland, Atlanta. So now we have only moderately is their best report. Okay, moderately is their best. Then modest in 1, 2, 3, 4, 5. And of course, you look at the size of the district. So we have 2 pretty good, and this one's okay. And Philadelphia had a slight increase. And St. Louis said mixed. Mixed is not good. Boston said higher sales and revenues, but mixed. So again, you got to watch out what they're saying. Higher sales and revenues than a year ago, but mixed. New York and Dallas described flat. Okay, 2 of our biggest markets flat. Boston mixed. St. Louis mixed. The other guys slight increase. That's not good. How do they say that economic growth expanded in most districts when it's barely moving? Okay, it's like having a guy in a coma and he twitches and you go, oh, look at that twitch, he's getting better. It's not good. Consumer spending increased in a majority of districts. Now, again, the majority means more than 6. So 7 districts maybe. Kansas City and Dallas weakness. When you have a good report, when you have a bullish report, you want to see zero weakness. You don't want to see some weakness. You don't want to see some mixed. You want to see everything should be up. If you expect the market to be going back to 2100, right, the S&P, you don't, 2100 on the S&P doesn't have weakness in it. All-time highs don't have the word weakness. They don't have the word mixed for that matter. They have the word strong. There's no strong yet. We haven't seen the word strong. Auto sales mixed. Elevated. Tourism strengthened. Strengthened from what? What was your base? Non-financial service activity grew slightly. Transportation mixed. Mixed means some up, some down. Weakness in the energy and agriculturals. Overall manufacturing activity was flat. Wah, wah. This is not a good report. Many districts reported the strengthening dollar. Okay, the only thing getting stronger is the dollar. And weakening global outlook negatively affected international. So international experts are negatively affected, but they have an excuse. Residential real estate sales rose in most districts. Home inventories were low. Residential construction activity strengthened. This is where I'm actually bullish on this stuff. As several Dallas note, strong growth in multifamily. That's not good, though. Multifamily construction is not good. Non-residential sales ticked up on net, although it ranged from flat to strong across the districts. I consider that the most positive thing they're saying. In the banking and finance, slight to modest increase in loan demand, stable credit. Agriculture, we know, is not good. And labor markets continue to improve, with a majority of districts reporting modest gains. Wage growth varied, flat to strong across districts, blah, blah, blah. Okay. Now, not seeing a lot of wage growth is good for companies because they don't want, and it's good for the Fed too. The Fed doesn't like wage inflation. When they tell you they want to fight inflation, the inflation they want to fight is wage inflation. They do not want wages going up. So the Fed is anti-wage inflation. They're there to support the businesses, and the businesses don't want to be paying more money to their workers. So when the Fed comes in and they start tightening, it's because they don't want wages rising, so that their corporate masters will then have to pay more money to people. That's what the Fed's job is. They in no way, shape, or form give a damn about the consumer, or the American people. So then these are the breakdowns of the specific things. But on the whole, all right, well, let's take manufacturing for example, because it sounded bad to me. Conditions in manufacturing continue to be mixed across districts. Boston, Cleveland, Atlanta, Chicago, St. Louis, San Francisco said flat to moderate growth. But New York, Philadelphia, big cities, Kansas, Richmond, and Dallas, another big city, declines. What? Slight to moderate declines. So we have 1, 2, 3 of the biggest cities in America say we're declining in manufacturing activity, while Boston, Cleveland, Atlanta, Chicago, and these couple big cities, and San Francisco, flat to moderate growth. That's not good. Context, Boston, Philadelphia, blah, blah, blah. Holy cow. Significant headwinds due to weak demand from the energy sector. Well, we just talked about that, right? Although San Francisco noted low energy costs have reduced production costs of steel products. Boston, Philadelphia, Dallas, San Francisco, strengthening dollar, weakening global outlook. That the exporting cities, continued sluggishness in agriculture with a headwind for manufacturing. That's again because if there's less agricultural activity, then they're not ordering other parts. And all these big parts of the things that we do make in America, unfortunately. And auto and aerospace had positive growth. Auto production, and that's the only part of the economy we do know is going well, is auto production. Future growth in manufacturing, positive. Expectations are positive. That's good. Boston reported positive outlook in manufacturing, with the exception of the auto and aerospace. So the ones that are doing good are now getting negative. That's not good. Contacts in Dallas and Cleveland, mixed outlook with concern over chemical producers and contacts related strictly to industrials. Okay, so not the best book, okay, which is, essentially what we expected. So how are the markets reacting? All right, well, they're reacting exactly how we thought they'd react. Where did we come in? Oh, yeah, so we're up $90 already. We'll see how it goes. All right, so that's where we are. And obviously, certainly you want to be out of those SQQQ longs by now. All right, let's get back to questions. All right, Nate, good call on LABU. I like that one. Citron shorting Tesla on CNBC this morning. They're right. I mean, look, you got to have the balls to short it. The problem with Tesla is so many people are believers in that. It's like a religion. So I don't short it, but I sure as hell don't go long on it. I mean, I do short it, but when it's at a ridiculous price. It's not at a ridiculous enough price for me to want to short it. We were short here. We shorted it up here in the 250s. We got out down here, or on the way down here. We were happy to take our money and get out when it got down here. It's not. If it got back to like 225, 230, I'd be very happy to short it. But I don't think they're ever going to see that again. I think the jig is up for these guys. Hopefully. And I say hopefully because frankly, I don't like, when you see $25 billion in market cap pouring into a company like Tesla, they're robbing $15 billion from other companies that should be getting funded. There's wasted money. It's a misallocation of the resources, of investing resources, driving their market cap up to 10 times what it should be. I mean, that's why I get mad about stocks like that, because I do. It's just annoying because there's other perfectly good companies that could use funding, while these guys are just, they just get as much cash as they need. It's ridiculous. Our oil and gas industry has laid off hundreds of thousands of people. Yeah, and it needs to, and they're not coming back. That's the thing, though. It's over. If you're in Canada, then I actually told the people on BNN a couple of weeks ago, I said, look, it's not coming back. Just give it up. Go find something else to invest in at this point. All right, PMI is down. Does that not mean energy consumption is low? It does. There's obviously a connection. Okay, manufacturing, energy, there's going to be a connection. But I'm saying, though, that to some extent, see, now you're saying consumption. Not necessarily the consumption. To some extent, obviously, the weakness in the energy sector causes less manufacturing because the stuff we manufacture is for the energy sector. But that's the real net effect. On the other hand, though, the PMI is down because, it's being affected by the energy sector. That's not bad, though. That just means that a couple of small parts of the economy are not doing well, but other parts are holding up quite nicely if you look at these reports. Okay, so consumption is down because we've gotten more efficient in our consumption. We use less oil to do things, and that's going to continue. We have, most companies now have CSL lights or LED lighting that uses way less power. They've got a lot of efficiencies of injecting air and stuff into these fuel mixes for the engines and turbines and so on and so forth. And of course, you've got more natural gas used instead of oil. You've got way more solar running things when they can. There's a big thing in WYNN. WYNN is huge now for energy. So the stuff where oil is used specifically is mostly in the transportation sector, and we're getting so much more efficient in our transportation consumption that it's no longer a valid signal. It doesn't tell you much. All right, but the PMI, but of course, as the energy sector collapses, the PMI goes down because it's still tied to the energy sector. But eventually, you're going to break loose of it. You're going to move on and find something else to do. I think I said last time we were talking, at one point, somebody made wagon wheels, right? At one point, there were people making wagon wheels all over the country, not wagon wheels and horseshoes for that matter, right? Huge industry, constant demand. Everyone has horses and wagons. That's how you get around. At some point, that part of the economy collapsed. All of a sudden, nobody needs wagon wheels or horseshoes. And the guys who make hay were probably freaking out. Like, how can people not want horses anymore? What the hell happened? How are people getting around? Oh, they get these newfangled cars. They don't eat hay. It's just you have to adapt to a changing economy. But the measurement, now, of course, the PMI of that time would have said, what's the most important companies in America? Well, the wagon wheel companies are the most important things, and they're going to indicate, the wagon wheel sales are going to indicate how good your economy is, because more wagon wheels means more transportation and more consumption, so on and so forth. All of a sudden, though, it's a stupid indicator. How many years did it take before they stopped measuring wagon wheels and start measuring autos? It's a long transition when you go from one kind of economy to another, and it takes many, many years. And you look in the past, and you don't think it takes years because you're looking back 100 years, and it took 5 years. You don't think about it. But these days, 5 years is forever in the markets. Nobody looks that far down the line. So Steve says, the trouble with low oil prices is the banks could get into trouble because of loans. Yes, definitely. There's all this spillover. It's going to be we're in a multi-year transition from one kind of economy to another. And the worst thing that can happen is for oil to spike back up artificially because they reduce supply, which will sort of salvage these relationships for another couple of years. So it's just going to drag out the pain. You know what I mean? It's going to make it drag out. Like, let's say the wagon wheel people cut their prices in half, and the hay people cut their prices in half, and a lot of people are saying, oh, well, you know what, horses are so much cheaper than cars, we're going to stick with horses for a while. What does that do? It doesn't fix the economy. It only makes everybody make less money because the car guys have to compete against the horse people, and everybody's giving up the money that they would have made on things. But at least the thing doesn't collapse all at once. That's a good thing about it. But it's still, over time, the same pain is going to occur. You're still going to get the transition. You can't stop it. Okay? All they can do is adjust to a lower consumption of oil moving forward. That's all they're going to be able to do. And as soon as they get used to the cars as soon as they get used to all these cars that get 35 miles a gallon, the next one kicks in a couple of years, and we're going to go up to 50 miles a gallon by 2025, which is not that far away. In 2025, all cars in America are supposed to get an average of 50 miles per gallon. That's another 30% less consumption than we're doing now in driving. Not only that, though, but these Boeing planes that are on back order forever, $500 billion worth of back orders of Boeing planes, when they deliver them, planes are going to use 20% less fuel. That's a disaster. That's like a huge amount of fuel that will be used in planes. And now trucks are starting to save 10, 20% on their fuel. All this is just hammering the poor oil guys, and there's just less and less demand, and you cannot increase consumption enough. You can't increase the demand for trucking and so on and so forth enough to make up for the loss of the actual use of it in the trucks that are on the road now. Every time a new truck is sold, every time a new plane is sold, every time a new car is sold, demand goes down a little more. Okay, so Tesla is part of the new economy. Electric cars are part of the new economy. But but that means the Chevy Bolt, B-O-L-T, not the Volt. The Bolt is a new thing coming out. That's a $30,000, 200-mile electric car. It essentially does everything a Tesla does, except it's not going to look fancy and it won't be as fast. But it's going to do, as far as being a functional car, it's got all the things that Tesla has. That's $30,000. So Tesla is not, again, this is a fantasy of Tesla. When they make a car for the people, it's going to have to be $25,000, $30,000, and they're not going to make any money. Okay, just like a normal car company, they'll make very, very tiny margins on it. So yeah, they're part of the new economy, but the part of the new economy is not that big. They're going to be a car company, and they're going to have a market share, some market share, but nothing exciting about it. And certainly nothing worth giving them 100 times earnings valuation. So what kind of catalyst will cause Tesla to be valued properly? Reality. I mean, at a certain point, people get sick of waiting for a company to come through on its promises. They're promising these ridiculous numbers with ridiculous margins that are not sustainable. And eventually, more and more analysts, like, what's his name that did it today, are going to wake up and say, hey, Phil's right. Let's start looking at this company like a real car company, because that's all they frickin' are. They're not a .com company, they're a car company. And like I said, there's a ticking bomb, because as more and more Teslas roll over, their sales 3 years ago were nothing. So the cars that come off lease from 3 years ago are not a big hit right now, but next year, finally get into the years where they sold like 20,000 cars, and then the next year they sold 30,000 cars, and last year they sold 40,000 cars. So when 20,000 cars come back, and you're taking a $10 million hit on $20,000 cars, $10,000 hit on $20,000 cars, that's a couple of $1 million or $20 million. That starts mattering. Okay, so when you're taking a $20 million hit on your off-lease vehicles, and you can't hide it anymore, and you can't stick it in some place on the balance sheet, then people go, whoa, what the hell is this? And as soon as somebody realizes what's going on with the leases, then they start projecting those losses forward. And then you say, well, your whole model is completely screwed up. And as soon as people start realizing that, they're in big trouble. So yeah, Citron is probably right on track to be shorting them now. But again, I'm not into that. It's just it's too iffy. They can go way up. If they hit 250, 220, I'm there for a short. But right now, I think it's a bit early. Okay, so biotech we talked about. ES is down. Watch TF and ISIS lower. Yeah, bad for ISIS too. Also, low oil prices are not bad for ISIS. They have big investments. All right, so now on to our trade. Let's see how we're doing. Dun dun dun. Oh, that's terrible. All right, made 110 bucks. 120. All right, it's not performing the way we wanted, but now we're in the trade, so we want to just watch the other stuff. Oh, and it's popping back up, so we're not happy. Oh, look at that. What a ripoff. Yeah, I don't think we should take 100 bucks off the table. That's going to be right down here. Now, see here, 9.2. If it says 9.2, I think it might be going down. 14.1, though, no. Ow! We got burned. Damn it. I had that feeling to get it off. So the market's holding up very well. I disagree. I think that the beige book wasn't that good, and I think that I want to be cautious here. But meanwhile, this trade's not working, so get out of it. All right, 40 bucks, big deal. If a trade's not working and you have a profit and you're not liking the way it's going, just get out. That's all. There's no reason to stay in a trade if it's not doing what you think it's going to do. I think it's wrong. I think it should be lower, and I wish I had taken the money when it was lower, but I'm busy, so what can I do? All right, so we have 16.8. If that's holding, it's good. 1973, 43.04, and 10.57. So there's nothing particularly here that's looking bad. So again, that's why no reason to be shorting the Russell if everybody else is holding up. So now we just got to watch and see if anything exciting happens, basically. All right, the dollar went down a bit. So why did the dollar go down? Because we're weak, okay? We had a weak report. See, the dollar traders are smarter. Dollar traders and bond traders are a lot smarter than stock traders. The dollar traders see the weak report from the Fed, and they go lower because they say, well, this is not good. There's no easing here. If there's no easing, then the dollar goes a bit lower, right? And I imagine that TLT went a bit higher. Oh, here you go. Here's TLT. So at the same time, here's TLT. Here's, well, not much, but it's a teeny bit high. TLT popped up a little bit. But as I was talking about this morning in the post, TLT is too expensive anyway, so I don't expect it to go higher just based on overall pressure. But the dollar is coming down pretty harshly now. And that's going to pop gold. It's going to pop silver. I still like silver long at 15, but it's a tough trade. And but it's also supporting, the lower dollar supports our indexes. So we can actually get back on this trade if we're lucky. Let's see what we can watch. I don't care about natural gas. Let's take a look at oil. Now, I don't know what they're excited about from the beige book. That makes no sense, but they're up since the beige book. See, here's where we shorted before. But I don't have a reason to short right now. I want to see how the S&P does in 1975. And let's take a look at the NASDAQ while we're doing it, because the NASDAQ NQ is in a good spot. So if the NASDAQ is holding 4,300, and oil's going up, and the Dow and the S&P is going up, and the Russell's going up, why would I short anything? That makes no sense, right? I don't have a good reason to short, so I'm not going to short. We had a catalyst off the beige book, but everybody seems to be, but now, 20 minutes later, it's being ignored. So if everybody's ignoring it, I'm not going to be the only guy who's going to insist that everybody pays attention. All right? But I am looking now because of my mindset. See, here's the thing. I believe I have information that other people don't have, or although they have the information, they don't understand it. So I think they're wrong. I think this reaction is wrong. I think there's nothing here to be bullish about. So I'm looking for a short opportunity. But I'm not seeing one, and I'm not going to jump ahead of anything. I'm going to let it ride and see what happens. If we get back to 160, I think I might want to take a poke at it. 1060. That seems like a fun place to take a poke. Or if I see these guys turning weaker, then 108.50 becomes a good spot again. 105.850. But I'm not getting enough of a signal here. I want to see all these three guys heading down at the same time before I start jumping back in the Russell as a short. I still like the Russell the most as a short because it had a nice pop from 1040 yesterday, and because it also makes very violent moves. So it could be kind of fun to make a short out of it. But again, it's just that I'm not going to get into the trade if it isn't looking solid. And a lot of things have been weird today. Like oil had a terrible, terrible inventory report. 10 million barrel build and a 3 million barrel build in distillates and maybe a million something drawn in gasoline. But that's just not supportive at all of $35 oil. Yet, what does it do? First, it pops down to 33.50. Then it zooms all the way up to 35, and now it's kind of settling back where it started. That's nonsense, though. There's no reason oil should be up here this high. Now, the higher oil, and again, now I say that, so that's a factor, and again, why I want to be short right now, because since oil shouldn't be this high, then maybe tomorrow or overnight it'll come back down drastically, and oil is still driving a good portion of the market, so that may knock everything back down again. Oh, where are we? 105.9, getting there. All right, so there's nothing much going on there. Actually, you know what we should do now? I wish I had more screens for this thing, but I can't do that. Let's check the news. Oh, that's weird. I have a very different news feed on mine than they have now. Oh no, this is their new thing. Yeah, this is weird. On the front page now, they moved the news. Oh, beige book reflects slightly gloomier conditions. While economic activity expanded in most districts, Philadelphia reported consumer spending increased majority, non-financial services grew, manufacturing was flat, residential real estate rose, labor market continued to improve, and whatever. Okay, so they have the same take as I do. They're saying basically a bit gloomier. Facebook doing very well. Just looking for anything that affects anything else. Disney Networks launch on PlayStation. Who cares? Boring. Victoria's Secret goes to StubHub in Shanghai. Grubhub. Under Armour. Fiat, Verizon. Oh, Verizon's challenging Netflix and everybody. That's going to be interesting with videos. Fiat, Chrysler. Oh no, it's AT&T that's doing the video. Verizon's doing other stuff. I don't know what Verizon's doing here. Oh no, they're doing a joint venture too. Damn it! Everybody's trying to sell you video on demand. It's going to be. I don't understand what they think people are going to do. They're going to have 5 accounts. It's so much simpler when cable had a monopoly. Cisco bought another guy. I love Cisco. Cisco, actually, we should probably, we need to put Cisco back in the long-term portfolio. Somebody remind me of that. Monsanto, ooh. Wow, that's ugly. Cut their guidance. What's bullish? What are we reading here that's bullish? Anything? Has anybody seen anything bullish here? Production declines challenge midstream MLPs. Rovi's another video thingy. God. Like I said, the new economy, right? Half the stories are about video crap. Carl Icahn, Dow, Taj Mahal, who cares? Short Storage, Global Investors, Ackman, oh, poor Ackman. Barrick Gold, Barrick Gold could cut debt by $4.5 billion. Barrick Gold has potential to reduce debt by $4.5 billion. We know that. RBC says the asset sale is likely to track favorably. They're selling these assets. Okay, we know about all this. This is all old news. Firms not expect to sell. Okay, all good. This is why I like every decision they're making here. I like all their sales. They're selling their they're selling their high cost mines. They're just getting rid of stuff that they're not going to bother. That they've got right now in this environment. There's no reason for them to hold on to this stuff because it costs them so much money to develop them and start mining them and expand the production that it's just not worth it to them. It's not it's not the margin they want out of the business. So they're doing everything that you want them to do as a management team. That's one of the reasons I love ABX. Really good job, man. 4.5 billion is huge. Following Electronic Arts, Activision drops out of E3. Wow. Oh, wow. That's a big deal. Activision is following the major competitor that won't have a booth at Electronic Arts Expo. Oh, my God. Wow. They're holding their own event. Oh, man, that's weird. This used to be Comdex, and then it turned into E3, because the Entertainment Expo, because everybody, you know, at Comdex, nobody cared about anything but entertainment after a while. And now, I'm not sure what the problem is with the Entertainment Expo, but now the biggest guys are dropping out of that. That's pretty weird. Saudi Arabia looking to borrow $10 billion. I would have to say that's false. They're putting out deals to bankers to get a loan of $10 billion. No, Saudi Arabia doesn't need a $10 billion loan. That is a false report. Shell being sued by Nigerians again. Oh my God. All right. Where are we down? We're down to 11 o'clock. There is nothing. Oh, Chipotle defended. Thank you. There was one thing. Okay, we're long on Chipotle, so I'm happy about that. There is nothing going on here that justifies any positivity in the market. Yet here we are at 1060 where I said I wanted to short. Oh, did I miss it? Come on, kids. Oh, you bastard! Ah! Such a frustrating job. All right. Not chasing. Missed the opportunity. So, plus these guys are kind of bullish, so it's really, we might actually break up. This might be just bouncing off it briefly. 105.950. All right, so 75.75 down. Up, oil down from where it was. NASDAQ still up. So anyway, so basically looking at the news, we've now discovered there's really nothing going on that makes us change our mind. I mean, it's still fairly bearish. So nonetheless, all right, let's go ahead and take one. Here you go. Come on, you bastards. Ah! Look how hard it is to get a fill. See, so they don't really want to sell me one. So I think this is a real BS move. Because they're not actually, see how fast it retreats from where I put my order in? I may be the only legitimate order out there. And all the rest is just bots trading each other back and forth trying to jack up the price. But I frankly don't think it's, I don't look, there's nothing in the data, there you go, Phil. There's nothing in the data there that tells me that I want to be in this, that we should be long here. I don't see how rational people can read that beige book and say, ooh, let's buy more, whatever. There wasn't even a sector that you want to be buying. There may be construction a little bit, but honestly, there's just not enough going on there that makes me feel positive. Now, unfortunately, until we get back to 1980 on the S&P, we don't have any particularly good stocks. We do now have, though, 34.64, so 34.75 on oil, 43 on the NASDAQ doesn't help any. So this is just a ballsy call because basically there's nothing stopping it from going higher. There's nothing stopping these guys from going higher. And if there's nothing stopping these guys from going higher, then he could pop and put us in big trouble. So you got to be careful to trade like that. But, I mean, and again, I do these things which are not the best trades, but I do it because we want to kind of demonstrate how you do these trades. But I am very concerned about this trade. Nothing here, none of these indexes are at a spot where I think they're going to hit serious resistance. Nonetheless, let's just play with this one. So we're going to try to work it down a little bit. I'd like my stop to be 1060, so if we can get 1060.01, I wouldn't mind adding another one with the intention of course, getting back out quickly and dropping my basis. So we'll see what happens. So in theory, though, the only thing that's actually hitting resistance, the only index that's hitting resistance right now is the Russell. at 1060. None of the other guys are at resistance. So it could easily pop it and then head higher, and that would be unfortunate. But we'll see what happens. We'll give it a few minutes and see if we make any progress. But I just don't see it. We had such a big day yesterday. Now we're positive today by what? Half a point, 0. See, now they're up. See, they're up too much though. They're up half a point. The S&P is at 0, and the NASDAQ is down half a point. So the Russell is way out of the league of the other guy. I don't see why we should be having a strong finish. Oh, here we go. 1061. Do I really want to do that? He who hesitates is lost. I didn't get my fill. Come on. See, 13.3 looks good. All right, I'll put one in. Let's do it. There you go. That filled way too fast. And when it fills fast, then you don't like it because that means that you might have a problem. Now, we now have 2 at 1060. So what I want to do now is get back out at 1060 and get back to 1, and I've dropped my basis. That's what I will have accomplished by this. But we'll see. It's unfortunate it seems to be going the other way, so we'll see what happens. And I'm watching him. Is he getting stronger? 25. I'm looking at the last 2 numbers. He got weaker. 50 is on this one. 25. He's getting weaker. 0. Good. Good. All good. Okay. Now I could sell, but I'm not going to sell because now I have new information. They're getting weaker, so I think I might go lower. I think I might actually get a better price. I may be being greedy. But I got 11.4. 11.4 means it's hopefully pressure my way. All right, let's. Oh. Damn it. Now, because I clicked on that, but it went lower, it became a sell stop. So I was able to cancel it, but now I can't. Now I got to go back into it. There. So now I've got my basis at 1060. Oh, shit. No, I did the wrong thing. Stupid. I sold it into buy. Now I have 3. Now I have 3 short instead of. Oh man! Don't go the wrong way on me now. That'll be so unfortunate. I meant to go to 1 short. I now have 3 short instead of 1 short. You always got to be careful of that. Spending too much time jibber jabbering and not enough time paying attention. I meant to buy 1 to get my thing back down. Oh, I'm so pissed. Oh, now it burned. But it went up to 106.90 before, so I have to be prepared to watch it go to 106.90 again before it comes back down. That's where the real resistance is on this one. These guys, when he was doing that, see, here's what you start paying attention to now. So he was at 106.9. When he was at 79.12, that's a lot higher, though. That's not good. I'm not happy about this at all. So I made a big mistake. I meant to go to 1 where I would be perfectly happy doubling down here, but now I don't want to. Now I have 3. I'm sure as hell I'm not going to double down to 6. Oh, thank you. Let's get back out of this thing. Oh, nope, not coming down enough. Now, I have to watch out that 1060 is becoming support. If 1060 is becoming support, that's a bullish sign. It means this thing's breaking up and over. He hit 14 now. See, I'm not paying attention. He hit 14. He hit 78. These are bad signs. Everybody's going bullish. And I didn't want to be short. I didn't want to be this short anyway. I only want to be 1 short. I did not want to be 3 short. So this is a mistake. You don't compound your mistake by pressing your luck. I made a mistake, so worst comes to worst, I should just get out of this thing and be done with it. So now that he's getting towards 15, I like 15 for a stop. And what did we say the stop was on this one? This line right here, see that? So 79. So since we're close enough to 15 and 79, I didn't think it would go that fast on those guys, then I'm a little more confident that this is going to hold. Let's see. Right here, got to hold. Nope. 161. Ah, you're killing me. Man, that was an expensive mistake. All right, let's add one more. Oh, okay. So now I've got to get out of 106.050, which is way down here. Oh, and he's one. Now see, we've got 1080 here, which is why I didn't mind doing it, because I think 1080 is at least going to be some resistance, and hopefully 4320 is resistance on the NASDAQ. And if it's not, we're going to be in big trouble on this trade. So now I have to look at this thing and say, well, let's see. I'm at 106.050. If I add one here, I only move the needle up 1/10 on everything. That's not really worth it. So it isn't worth adding any more at this point. I'm just going to have to sit there and see what happens. But again, I'm very much of the opinion that cooler heads will prevail into the close, and then we're going to have a bit of a sell-off. So let's see if we have any questions while we're doing this, even though I might lose a lot of money while I'm answering questions. Oh, no questions. Isn't the dollar decline keeping the oil and the indexes up? Yeah. That's part of the problem, is that the dollar's coming down. Where is DX? But see, it's held at 98. So I think it's more going to be about what oil does into, well, oil of course stops trading, just stopped trading. So that's effectively where oil closed for the day. It still trades in the futures, but the NYMEX trading stops at 235. So we're just going to see what happens. He's still below 1980. That's a good sign. Hopefully we get rejected there. And he's all the way up at 106.05. What was my break even? Why am I so confused? Should I have gotten out there? Isn't this where I'm even? I got to pay more attention. Yeah, there we go, 20 bucks. That's funny, we down only 200 for a minute. All right. So ideally, as long as he's under 1980, oh yeah, thank you. Okay. There goes one. Come on. Look at that profit. Are you kidding me after all that? What a joke. Ain't a profit until I get rid of that contract, though, I tell you. There you go. Okay, now I feel so much better. All right, screw that. Let's get back to one. Yay! All right, so the P&L for the day is what matters, 20 bucks. So effectively, 106.030 is my break even now. But that's good. See what happens is effectively, because we stuck with our plan, we raised our basis, in this case raising our basis because we sold more at higher prices. We raised the short basis to 106.030. So now even if we take another run back up to 161, now it's effective for me to sell another one, because I can move the needle back up closer to 1061. Okay, I don't know if I'm going to do that though, because we're still up here, and I'm just worried about this right here, 1979. I don't want to see 1980. That means this trade's in big trouble. And again, it did not go the way I wanted it to. I'm not pleased, so I'm not really dying to stick with this trade. I think I get 20 bucks off the table here, because what do we make on the other one? I forgot what the other one was. I don't know. Well, we made 100 on something else. So I mean, I'm not looking to overdo it. But here you go, 1978.50. So there goes 1979 is gone. Good sign. 43.20 not breaking here. Don't care about oil anymore, so let's start looking at the Dow instead. So that's going to be YM. And the Dow, 16,850. Oh, that's a good line too. See, I didn't see that line. That's another good stopping line. This trade might end up working out. See, now I wish I could throw a 4. But anyway, so that's the point of the future, though. You have to, you have to scale in, but if you're going to scale in, you got to remember to scale out, because the whole point of scaling in is to reduce your basis, or raise your basis in this case because we're short. But the point is to move the needle on your break-even point. But it doesn't matter. It doesn't count if you just keep adding contracts, because then until you get rid of them and get back to a lower basis, you're not doing anything. You're not accomplishing anything. And so what are the steps we went through? First of all, I adjust the basis. I check my other levels. I check the news. This isn't happening in a vacuum. I want to see what's going on. I had a premise that the beige book wasn't as good as people thought. Therefore, all the people being bullish were being silly. Then I go back and I check the news. All right, and the news, as reading the news, I didn't see anything that made me say, oh, I should be changing my mind here. Then I checked my levels, even though it was going against me. I said, oh, look at that. Now we got some resistance here. There's resistance here. There's resistance here. This is a good reason I could stick it out until we retest the high over here. And it went a little bit above the high, the previous high, but not so much, and we managed to work it out. All right, so now what I'm hoping for is a repeat of this M. See this M that's kind of forming here? Up, down, up. I'm looking for that down at least to here, which is where we started off when I said I'm hoping to make $400 on this trade. So I still think we're going to get down to like 105.6, 105.7. That's good for $300 or $400, but it's not going to happen in the time that we have remaining, which is negative 15. So we're going to call it a day. We'll see how it goes. So today, unfortunately, didn't do as well on this seminar so far. But I think it was oil that we traded earlier, right? No, what did we make a profit on before? I forgot. Anyone remember? I don't remember. I don't remember what the hell I know we made money on something. But whatever. Wait. Watch the TF. Oil. It was oil, right? That's weird. Okay, so we made money on oil before. But we're out of that trade now, so now we'll just see how this one goes along. This is up $50 so far, so we'll see how it works out. But hopefully, like I said, I'm hoping this M pattern follows through. It doesn't look like much, but if you just if we get a little curl over here and we come back down to 105.7, that's going to be a $300 gain. All right, so that's going to make us happy. That'll be like $400 for the day, so that makes it worth your time to spend on this seminar. And again, it goes back to fundamentally reading the news, looking at what's going on, looking at the beige book. I don't see any reason it would do anything different. All right, so we'll check that next week and see how this trade turns out. And everybody have yourselves a lovely, lovely day. All right, thanks for coming. What's the new oil trade? There is no new oil trade. We're generally bullish on oil from this level, from 30. And we traded the futures before, made a little bit of money on it, but in general, we're not gung-ho on oil. 35 is kind of toppy. We were shorting oil earlier at 35, but only toppy in the little tiny range between 32.50 and 35 for now. It'll eventually, maybe in April, break over 35, maybe even this month if something happens with OPEC, and then we'll be back to like the 35-45 range for trading oil. So in general, though, we're bullish. We have UCO in one of our portfolios. We have USO. In fact, I just pointed that out to the members earlier. In fact, so we do have a list in member chat before we were talking about being long on oils. Where did I make that number? Oh, here we were talking about shorting oil at 35 earlier too. This is what this whole conversation was about. There you go. Oil over 35. Surprising, but fortunately we're long VLO, BHI, UNG, USO, UCO, RIG, OIH, Seadrill, Encana, and BP. Those are our longs in our portfolios. And 35, I was showing that being short here. We're shorting oil at 35 until it stops being a good short. It hasn't stopped being a good short at 35 yet. Okay, oil still generally, when it hits 35, tends to get rejected and come back down. It went a tiny bit over before, but we had a wonderful run all the way down to 34.30. We stopped out at 34.50. That's good for $500 in between. So when something pays you $500 over and over again, you take the money, and when it finally burns you, you say, okay, that one, it's not working anymore. That's how we end the trade. But for now, still short term, we think 35 is the top. Long term, we're looking for like 45 in the summer. So a little bit contradictory, but that's just the way it plays. All right, once again, now we're done. Thanks everybody for coming. I'll see you next week.